Central banks are buying gold at the highest levels ever recorded in modern history. Not just high levels, record levels. 3 consecutive years of record central bank gold purchases. Sovereign nations, the most sophisticated institutional buyers on the planet, accumulating physical gold at a pace that has never been documented before. And silver, sitting at a historically cheap ratio to gold, is being completely ignored by those same central banks. Record central bank gold buying, silver ignored. If you have been asking why silver price is not benefiting from the same institutional buying wave that has driven gold to $5,000, today we answer that completely. With data, with the actual central bank purchase numbers, without drama. This is your central bank gold silver complete breakdown. Who is buying, how much, why silver is being ignored right now, and exactly what changes that dynamic. My name is Stack AG. We invest with logic, not hype. Let us get into the data. Let us start with the actual central bank purchase numbers, because these numbers are extraordinary and deserve precise examination. The World Gold Council publishes quarterly data on central bank gold purchases and sales globally. Their data for the past 3 years tells a story that has no modern historical precedent. In 2022, central banks globally purchased over 1,000 tons of gold, the highest annual total ever recorded, breaking the previous record by a significant margin. In 2023, central banks purchased over 1,000 tons again, the second consecutive year of record purchases, sustaining a pace of buying that most analysts had assumed was a temporary 2022 anomaly. In 2024, central bank gold purchases remained at historically elevated levels, confirming that this is not a temporary phenomenon. It is a structural shift in how sovereign nations manage their reserve assets. 3 consecutive years, over 1,000 tons purchased annually by central banks, not by retail investors, not by hedge funds, by sovereign nations with multi-decade investment horizons and access to the deepest economic analysis on the planet. China has been buying gold for 16 consecutive months without pause. The People's Bank of China has been adding gold to its official reserves every single month. Turkey, India, Poland, Kazakhstan, Singapore, Czech Republic. Central banks across the developing world and beyond are systematically increasing gold as a percentage of their total reserve assets. This is the most powerful sustained institutional buying wave in gold's modern history. And it has been the primary driver of gold's move from $2,000 to over $5,000 per ounce. Understanding why central banks are buying gold at record levels is essential, because the reason tells you whether this buying continues and what it eventually means for silver. The primary driver is de-dollarization. For decades, the US dollar has been the dominant global reserve currency. Central banks held the majority of their foreign exchange reserves in dollar-denominated assets, US Treasury bonds, dollar cash, dollar-priced instruments. This arrangement worked when the United States was unambiguously the world's dominant economic and military power, and when the dollar system was seen as reliably neutral, not weaponized for geopolitical purposes. That perception changed dramatically in 2022 when the United States and its allies froze approximately $300 billion of Russian central bank reserves held in Western financial institutions in response to the Ukraine invasion. The message that action sent to every central bank on Earth was unmistakable. Dollar reserves held in Western institutions are not safe from political seizure. If geopolitical relationships deteriorate, your reserves can be frozen. Regardless of the legal framework that was supposed to protect them, every central bank on Earth immediately began reassessing its reserve asset allocation. The question every sovereign reserve manager asked was simple. What assets cannot be frozen? What assets carry no counterparty risk to Western financial institutions? The answer is physical gold, held domestically in your own vaults, under your own sovereign control. Physical gold cannot be frozen by a foreign government. It cannot be sanctioned. It cannot be seized remotely. It is the ultimate no counterparty risk reserve asset. And the buying wave that began in 2022 and has sustained at record levels for 3 consecutive years is the direct consequence of that geopolitical realization reshaping sovereign reserve management globally. Now, the critical question for silver investors: if central banks understand the value of no counterparty risk physical assets, why are they buying gold and ignoring silver? 4 specific reasons. All real, all documented. And importantly, all subject to change. Reason 1, reserve asset classification. Silver is not classified as a reserve asset by the International Monetary Fund. Gold is. The IMF's reserve asset framework, which central banks globally use as a reference for their reserve management policies, includes gold as a Tier 1 reserve asset. Silver is not included. Central bank reserve managers operate within policy frameworks. Those frameworks reference IMF classifications. Silver's absence from IMF reserve asset classification creates an institutional barrier to central bank silver purchases that gold does not face. Reason 2, storage and logistics at scale. Central banks buy gold in quantities measured in tons. A ton of gold at current prices represents approximately $160 million of value. A ton of silver at current prices represents approximately $3 million of value. To accumulate the same dollar value in silver as in gold, a central bank would need approximately 50 times more physical storage space. The logistics of storing and securing that volume of silver, transportation, vaulting, insurance, auditing, create practical constraints that gold does not have at equivalent dollar value. Reason 3, market liquidity at sovereign scale. Central bank gold purchases are measured in hundreds of tons annually. The global gold market, at approximately $5,000 per ounce, has sufficient daily trading volume to absorb purchases of this scale without extreme market impact. The silver market, at approximately $90 per ounce, is significantly smaller in dollar terms. A central bank attempting to purchase silver in quantities equivalent to their gold purchases would face severe market impact, moving the price against themselves as they buy, creating practical constraints on position size that do not exist in the gold market. Reason 4, policy conservatism. Central bank reserve management is institutionally conservative. They follow precedent. Gold has a centuries-long history as a central bank reserve asset. Silver's monetary role was officially ended with the demonetization of silver coinage in the 20th century. Reintroducing silver as a formal central bank reserve asset would require policy innovation that conservative institutions are slow to adopt. Here is the part of this story that most silver analysts are not discussing, and it is arguably the most important element for silver investors to understand. The 4 reasons central banks are ignoring silver: IMF classification, storage logistics, market liquidity, and policy conservatism, are all institutional barriers. Not fundamental barriers, they can change. And there are early signals that they are beginning to change. Signal 1, IMF reserve asset reclassification discussion. Within academic and policy circles, there is growing discussion about whether silver should be reconsidered as a reserve asset, given its critical industrial role in the energy transition. Solar panels to EV batteries, semiconductor manufacturing. Silver is no longer just a monetary metal. It is a strategic industrial metal that nations need for their energy security. That strategic importance is creating policy conversations that did not exist 5 years ago. Signal 2, sovereign wealth fund silver accumulation. While central banks have not yet formally adopted silver as a reserve asset, sovereign wealth funds in several nations have begun increasing silver exposure. Sovereign wealth funds operate with more flexibility than central bank reserve departments. Their early adoption of silver as a strategic asset often precedes eventual central bank policy changes. Signal 3, China strategic metal reserves. China classifies silver as a critical strategic industrial metal, not a monetary reserve asset. But China's state-directed accumulation of critical industrial metals, including silver, through state-owned enterprises and strategic reserve programs, effectively functions like a central bank reserve operation, without the formal IMF classification constraint. If China's approach to silver as a strategic metal reserve influences other nations, the institutional barrier to sovereign silver accumulation may erode faster than the formal IMF classification process would suggest. Here is the mathematical implication of central bank gold buying for silver that most investors completely miss. Central banks buying gold at record levels drives gold price higher. Gold at $5,000, potentially $6,000, potentially higher. The gold-silver ratio, currently at approximately 65 to 1, is directly affected by every dollar gold moves higher without a corresponding silver move. If gold reaches $6,000 and the ratio stays at 65 to 1, silver's implied fair value is $92, already above current levels. If gold reaches $6,000 and the ratio compresses to 50 to 1, silver's implied fair value is $120. If gold reaches $8,000, which serious analysts now consider possible, and the ratio compresses to 45 to 1, silver's fair value is $178. Central bank gold buying is not just a gold story. It is a silver story, because every dollar gold moves higher, and without central banks buying silver, widens the ratio. And a widened ratio is simply accumulated catch-up potential for silver when the ratio eventually compresses. History says the ratio always compresses after periods of extreme divergence. It compressed in 2011, it compressed in 2020. It will compress again, and when it does, from whatever level gold has reached by then, silver's percentage move will dwarf gold's percentage move. Central banks ignoring silver is not making silver irrelevant. It is making silver's eventual move larger. Here is how central bank gold buying connects to everything else we have been tracking on this channel. Central banks buying gold drives gold higher. Gold higher widens the gold-silver ratio. Widened ratio increases silver's mathematical catch-up potential. Simultaneously, COMEX silver registered inventory is 86% exhausted. Physical silver is leaving the paper market system. Shanghai is paying premiums above COMEX spot price. Chinese buyers cannot find enough physical silver at benchmark prices. Retail silver is selling out. Individual investors are paying elevated premiums and waiting weeks for delivery. Solar silver demand has grown 400% in 5 years. Government mandates are driving consumption that mine supply cannot match. Industrial demand across solar, EV, and semiconductor sectors is at record levels and growing. 6 independent signals, 6 separate layers of the silver market, all simultaneously pointing to the same conclusion: silver is worth more than the paper price admits, at every level of the market, from sovereign institutional all the way down to individual retail. And central banks ignoring silver while driving gold to record highs is simply adding mathematical fuel to the ratio compression that historically always follows periods of extreme gold-silver divergence. This is not financial advice. Always consult a qualified financial professional before making investment decisions. The central bank gold buying story has a direct and powerful implication for silver investors that is easy to miss if you focus only on which metal central banks are buying, rather than what their buying does to the ratio. Central banks buying gold at record levels is not neutral for silver. It is directly bullish for silver because it drives gold higher. And gold higher with silver flat means a ratio that historically always eventually compresses, and compresses dramatically. For long-term silver holders, the central bank gold story is confirmation that the precious metals bull market is institutional, not retail. Sovereign nations with the deepest research and longest investment horizons on the planet are validating the hard asset thesis. They are buying gold. Silver is the same thesis at a historically cheap ratio. For those considering entering, understanding that central bank buying is structural, not cyclical, means the gold bull market that is driving ratio extremes is not ending soon. Which means the ratio compression trade has time to build further before it resolves. Accumulating silver during this building phase is historically where the best risk-reward has been. Physical silver, no counterparty risk, no paper claims. The asset that central banks have not yet discovered, but whose ratio to their preferred asset is building extraordinary catch-up potential every day, they keep buying gold. We do not sell silver. We do not sell anything. Anyone claiming to be Stack AG and offering precious metals or investment products is a scammer. Block and report immediately. Central banks are buying gold at record levels. Silver is being ignored. Stack AG is here every day. Every central bank purchase report. Every vault number. Every ratio update. Every physical market signal. So, you always have the complete picture before the mainstream does. Subscribe, hit the bell. Share this with one gold investor who has not yet understood what record central bank gold buying means for silver. I am Stack AG Invest with Logic. Not hype. See you tomorrow.